Welcome everybody, it's Richard Wilson, and today we're doing a member spotlight video here, one of our members in the Family Office Club. And we have Chris here today from Caliber. And I've known Chris for probably 4 or 5 years now. Spoke at one of his events and it's grown enormously. It's about 4 times larger, I think, than the last time I saw him in person in terms of the growth of his firm. So welcome, Chris, to the interview.
Thank you. Happy to be here. This is exciting to see you again. I think last time we were having a cup of coffee, we were talking about growing our businesses, and today I think we've definitely achieved that. So congratulations to you as well.
Great. And can you talk a little bit more about Caliber, maybe a little bit about the size of your team and organization, because I think we've gotten to a stage where it's highly credible, so it'd be good to shine a light on that, and then maybe a one-liner kind of description of what you're up to.
Yeah, so from a one-liner standpoint, we look at ourselves a little bit like a middle market Blackstone. So we're focused on high net worth individuals and the advisors that help them. We help them invest in private real estate funds and build wealth through different forms of real estate. One of those things is that we happen to be one of the largest opportunity zone funds and sponsors in the Southwest region. And we focus on middle market real estate. So buying projects typically that are $5 to $50 million in size, typically that are hard to acquire or that require some sort of special capabilities, which gives us, in our opinion, a much better price and much better deal on the project. And then last but not least, we're vertically integrated. So we are a full service platform. We do development, construction, fund management, acquisition, kind of you name it. So soup to nuts, we take responsibility for the projects, and that's one of the things that's helped us be successful, especially as the market continues to change.
Great. And let's talk about opportunity zones for just a minute. There's a lot of discussion around that at the conferences that we're usually hosting. How are investors benefiting from those right now, do you see?
I think a lot of talk on opportunity zones goes around the tax consequences and sort of the nuts and bolts of the program. I like to take a little bit of a step back and talk about the investment. If executed appropriately according to the program, you can effectively double your return on investment over a 10-year period when you calculate the additional tax benefits. Another way to look at that is if you have a large, short or long-term capital gain and you're going to pay a big tax bill, you can defer paying that tax bill, but the benefit you gain from investing in the program will likely exceed the cost of that original tax bill. So over a period of time, you can eliminate that tax.
I see. And I just want to clear up, when you said that you're from the Southwest and Mountain West regions, what city are you most active in or based in, and what are the top 3-5 cities you're spending your time in?
Yeah, so we're headquartered in Scottsdale, Arizona. Obviously in the greater Phoenix metro area is our most active area. Focused right now on Arizona, Colorado, Texas, Nevada, Utah, and Idaho. And we consider this, we call it sort of the greater Southwest growth market. So these are markets that have long-term trends of population growth, long-term trends of job growth. They happen to actually be performing quite well during the current period of time that we're in. And there's just a lot of resiliency in these markets. And since we're investing, especially in the Opportunity Zone program, for 10 years or more, we need to be investing in a place that's not relying on any one specific factor.
Right. Okay. So I know there's hundreds and hundreds of funds launched, every year. And I know one thing that's unique is you guys are a bit vertically integrated. You take responsibility for the project. You're not just investing in something and walking away and having the property manager, renovate and manage the whole thing. I know that you guys are strong in opportunity funds. I know from our past discussions, you have sometimes a couple different types of opportunities available to investors. All those things sound unique compared to the average independent sponsor type group or real estate investment firm. But what else makes your firm unique that's been part of your momentum? Because you've had great momentum compared to your competitors.
Yeah, I try to explain things in a way that would resonate with me if I'm sitting in the investor's chair. So at the end of the day, there's about 400 funds in the country that are open for business in some way, shape, or form. Caliber is one of those. And the way that we fit in the market is that the majority of those, at least 300, are single asset funds run by relatively small developers that may be amazing real estate entrepreneurs and really good at what they do in terms of that one specific project, but they're not set up with an institutional infrastructure. So managing the tax consequences of the investment over a 10-year period of time, managing proper cash allocations and ratios and all those types of things are really important in this program. And most investors can't see that far into the program to see how important that really is. On the flip side, there's a handful of large institutional investors that are doing funds in the $1+ billion range. Ours is about a $500 million fund. And they're great. They have all the infrastructure, all the reporting, all the financial management you could ever need, but they don't have access to the deals because most of these investments are these $25 million deals, not these $250 million deals. And so they don't have that entrepreneurial deal platform. So Caliber is a special business because not only do we have the institutional infrastructure, but we also have the entrepreneurial deal platform. And we combine that into a mixed fund, meaning when an investor makes an investment, unlike most funds, they're trying to pick one sponsor and one deal and hope it works out over a decade or longer. In our fund, they are picking one sponsor, but they're going to be diversified across many deals. And we have the ability to sell and reinvest and compound their return. The most important tax benefit in opportunity zones is the fact that after a 10-year period, if I've grown the value of the investment, the investor pays no taxes on the growth. So if I can compound the returns, I can grow that value significantly more than if I'm making one bet at a time.
Right. Okay. And I know you might have multiple offerings, but if it's a non-opportunity zone type investment, what's the investor holding period where they'll be in the fund waiting to see what that return will be?
Yeah, so we have offerings that range from a year to 5 years on that side of the equation. And then, of course, the Opportunity Zone program being a 10-year program is the minimum.
Right. Okay. And what about during the virus crisis here? Someone might be watching this once it's passed, but for those that are watching this kind of near term, what are you doing to adjust your strategy right now?
So Caliber was founded by myself and several other entrepreneurs who built this business in late 2008. So we actually didn't know what a normal real estate market was. We only knew what a distressed market was at the outset. So we've sort of activated an infrastructure that's been somewhat dormant in our business just to prepare, just in case we see this continue to degrade, because there's definitely a possibility that you could see the bond markets start to crash in terms of real estate mortgages. There's a possibility you could start to see a spike in foreclosures. And so what we've essentially done is we've been in due diligence or in purchase contracts on at least $500 million worth of property. We walked from all of that about a month ago. Great projects, and if this thing clears up in a couple months, we'll be back to them. But in the meantime, we're now reaching out to the entire brokerage community, all the special servicers, all the lenders, all the bankruptcy attorneys to let them know, hey, we know how to buy distressed real estate. We know how to do loan workouts. We're here. We're capitalized. We're bringing in capital every day. And so, I think what will be different this time around than what most investors understand from 2008 was after that financial crisis, we had years to try to sort of sort our way through it. This time around, the banks and everybody, all the players in the market have built a significant amount of infrastructure to be prepared for another sort of foreclosure crisis. And so it will happen a lot faster. The assets and the deals will go to a much smaller group of people. And you have to be invested in the market and into, sort of pick your pony, be in at least one fund that can take advantage of that type of market in the future.
Right. I know Ray Dalio recently said that cash is trash if you don't put it to use, because it's just going to be inflation from printing all this money, right?
Totally.
And it's the time to be investing in something, right? Like whatever is the right risk appropriate investment for someone, or probably multiple investments.
Aside from gold, real estate has done really well aside from gold in terms of beating inflation.
Right. And you talked a little bit about middle market real estate. I don't know if you want to comment on anything else related to that, but if I understand it, you're focused on above where the mom and pops and little startup sponsors would be, the casual investor who's maybe in a cubicle most of their life, investing on the side, but you're below where the heavy hitter institutions, the multi-billion-dollar funds are coming up. They would see it as a waste of time to acquire a $25 or $75 million asset. Is there anything else you want to add to that to make it really clear?
Yeah, I just want to bring your investor into my chair. So in that scenario, in both those, I call that the entrepreneurial and the institutional market. In both of those cases, if I go to buy a project in that market, in a normal market, there's probably 20, 30 bidders. The pricing is hyper efficient, and it's going to trade for a number that's in a pretty short band. In the middle market, there's a lot less players because it's complicated, but it's also smaller than the institutional side. And so in that case, I might be bidding against 5 other buyers. 3 of them may not have the funds to close at that moment in time. And so we have a lot less competition. And that's how we derive a better price and a better return, even in a normal market.
Right, right. Okay. Are you then bundling up a few of these assets upon the sale and selling a portfolio to arbitrage that, just like an operating business would with EBITDA getting up to the private equity levels? Is that
Exactly. Yeah. The more
okay?
that we can kind of groom the portfolio and build it out so that the institutional buyer can then buy it in an easier transaction, the better price we get.
Right. Okay. And then you mentioned some regions earlier, Idaho, Colorado,
Mhm.
Arizona, obviously Phoenix, Scottsdale, and Denver. Denver especially has seen, a lot of movement there. There's more jobs created in Phoenix than almost anywhere else.
Yeah.
Denver's also had great job growth, especially for millennial and tech related jobs in the whole state of Colorado. Besides those two exceptions, most of the regions you talked about are not super overheated, classic type, coast based locations. You also happen to be based in Scottsdale, so that makes it easier to get deals done locally. But
Yeah.
what else is going into your selection of those regions that you could also clarify a bit more when people are wondering why you don't go into the Carolinas or don't go into Nashville or areas like that?
Yeah, so you have to be able to project influence to do what I do well. And one of the ways that we do that, for instance, is we have a full-time gentleman on staff who works with all of the politicians. So I'm talking state, city council, governors, state legislators, et cetera. So there's only so much we can cover as a business and that we can afford to cover, because at the level that we work, we want to be first at the table. We want to be able to execute on our developments quickly. And in our region, we do happen to have some of the best and fastest growing states in the country. I mean, Boise, Idaho is the fastest growing city as of last year in the country. Now, that's because it's relatively small and they've grown a lot, but so on a percentage growth, it's been pretty fast. But we're building, looks to be a medical office facility there. And I'd like to own one of those in Boise, Idaho. Same thing in Austin, Texas, or San Antonio, or places like that. So they're still amazing cities to invest in, harder to access for an institution because they can't really afford to open an office there and build local knowledge. But anything within a 2-hour direct flight from us that avoids fighting, and as you mentioned, the coastal markets is a good option for Caliber.
Sure. And when you talk about your value add process, obviously being vertically integrated, focusing on these regions, having the capability to do workouts and be able to perform in a struggling, economy potentially, which might be coming upon us right now. Mm-hmm. Obviously those are parts of your value add process, the regions, the lobbying, et cetera. What else goes into it in terms of your value add process that's part of like a go-to kind of step-by-step plan that works for you?
Yeah, so it's sort of the same thing as how is the sausage made? How do you get to the point where you generate an outsized return on a piece of real estate? Well, one of those things is the development side. So your development is imagination. It's what could this asset be? How can we transform it? How can we build it? How can we get it through the city? All of those types of things. Well, we have a development company in-house. But that doesn't mean we're driven by our egos, that every single development we have to run. Oftentimes we'll have an entrepreneur who's been working on a deal for 5-10 years, trying to get something approved by the city. They finally do. They can finally stand it up, or they can finally go through the renovation or whatever the plan is, but they don't have the financial wherewithal to do that. And so we step in, we act as the lead general partner, we sponsor the debt. They come in as a junior partner and they report up into our development company. So we're not just relying on their word to execute on the development. They're now being overseen by an experienced group. And so it's kind of understanding the nuance between, yes, we're a licensed general contractor, but more often than not, we're going to be a construction manager with our GC overseeing another GC who has better execution ability in that specific asset or that specific market.
Okay. And I know we just have another 3 or 4 minutes here, so I just have 2 quick questions. What's the number one best due diligence question that an investor should be asking a firm like yours, whether or not they're ever asking that question? What's the best question?
Best question by far. How did you build a culture in your business designed to deliver me a return? I think we often forget in this age of technology, automation, AI, that kind of stuff, that the real estate private equity business, by and large, is still a people-driven business. And at the end of the day, the way that you get a return as a client is that the people you hired show up every day and make good decisions. And many of those decisions will be completely opaque to you as an investor, because whether they did, the right thing for that asset that day or not is really impossible for you to know. And so understanding how that business built a culture designed to deliver results, and with, sort of financial incentives like at Caliber, everybody at the company is a shareholder. Everybody at the company gets profit based on the assets profiting themselves. Our fee income covers our overhead, but it doesn't cover a profit for the company. The profit comes from the profitability of the projects. And so all of those types of things that create alignment between the people that are working for you as an investor and what you're looking to achieve are the things that really, truly matter. Every good company has an audit. Every good company has all those basic infrastructure things, but those things are just going to tell you years down the road, did you make a good decision or not? They're not going to tell you in the moment, do you have a team that's working hard on your behalf and making good decisions for you?
Right. Great. Yeah, I never heard anyone answer the question quite like that, so appreciate that. And the last question here, the $100,000 piece of advice you could leave us with related to commercial real estate or investing, in a group like yours. It could be for someone in the real estate space or an investor.
I would say that for $100,000, it's pretty easy in the opportunity zone space. Take that, divide it by 25%, and say, if you've had a capital gain in excess of $400,000, I can save you $100,000 by investing in the program. I went on a roadshow a couple of weeks before the pandemic hit pretty hard. I spoke to 150 sophisticated, amazing investors, like the head of Wedbush for Europe and such. And I would say about 2/3 of the room, mostly professional investors, financial advisors, the folks that advise, high net worth individuals on a regular basis, they didn't even know what the program was, let alone the fact that they could take gains from the recent sale of stock that they all harvested at the end of last year and put those gains into real estate and save on taxes. And so if you're a high net worth individual looking at this, if you're a family office and you're still kind of scratching your head as to why nobody's recommending this to you, it's not surprising to me. I talk to CPAs and financial advisors all the time that are still not quite sure how to even talk to their clients about this program.
Which is kind of amazing that that's the case. It's like someone not knowing what a family office is. It kind of blows your mind when you remember there's people like that out there, and then you realize there's millions of people out there like that.
Yeah,
so.
Absolutely.
Great. Well, where's the best place to get a hold of you, Chris, and to connect with Caliber?
Very easy. You just go to our website. It's caliberco.com. It's CALIBERCO.com. And I'm easy. I'm Chris at caliberco.com. Not hard to find me.
Great. Awesome. I appreciate your time here today. And I'm sure we'll get to see you involved in the Investor Club here going forward. And congrats on all the growth.
Thank you.